30 for ACCA and SBR paper. So guys, in this session, I'll be discussing section C, question number 31, that is from group P&L, and question number 32, that is from interpretation of financial statements. Okay. Now, additionally, I'll also be uploading one more video on section B, earning per share question in the same YouTube channel. If you need that, please comment earning per share and also enjoy watching section C. But I'll request one thing, please solve it on your own and then watch this session. It will help you a lot in that case. Okay, watch it. This question is particularly from group accounts. We know in section C there are two questions of 20 marks each. 20 marks each. Okay. Now, one question will be from preparation of financial statements. It might be from group accounts or it might be from single entity. And one question will be there from interpretation of financial statements, right? So now this is the first question from the preparation of financial statements, and we see a question of group accounts. We see a question of group accounts. Now tell me, I have been telling you time and again, in group accounts, what is the favorite topic of the examiner? Tell me guys, in group accounts, what is the favorite topic of examiner? Group P and L, and that's what they are asking here, and that's what they are asking here, right? So let us now go ahead and discuss this question. Okay, chalo. I will request your active participation in the class. Now the question says on 1st January 2005. Okay, before reading the entire question, just let understand the structure of the question. Okay, so on 1st January 2025, it is giving you the purchase consideration. Then the question is giving you the profit or loss. Reporting date is given. Okay, then further, if we go down, then the question is giving you certain adjustments. Okay, what else? What else? Certain adjustments, fine, cool. Now the question is also giving you some goodwill requirement. Okay, fine. What else? Just a minute. Now, okay. So the question has requirements, three requirements. The question now has three requirements. One is the calculation of goodwill. One is the calculation of goodwill. Another is point number two is, you can say, preparation of statement of profit or loss, and the third is the business combination, some theoretical topic, okay, some analysis topic, you can say. Okay, so there are three requirements of the question. First requirement is goodwill, second requirement is console profit or loss, and third requirement is some theoretical analysis. Now let us read the question, try to understand the question and solve it. Okay, now, so question says on 1st January 20x5. Now I have always mentioned, whenever you read the question, check two dates properly. What are the two dates? One is the date of acquisition and another is a reporting date. Okay, check date of acquisition and the reporting date. So what is date of acquisition? On 1st January 20x5. Okay, what is the reporting date? 30th September 20x5. How much percentage have we acquired? How much percentage have we acquired? 80 percentage. How much percentage we have acquired? 80 percentage. Okay, so now let us write this data in the Excel file, in the spreadsheet, you can say. So acquire on date of acquisition. Just a minute. So date of acquisition is 1st January 20x5. How much percentage we have acquired? 80 percentage we have acquired. Now, what is the reporting date? 30th, not 31, 30th September 20x5, meaning thereby the subsidiaries acquired in the mid of the year. In the mid of the year, okay. Now, during the year, we can say, during the year. Now, in this year ended 30th September 20x5, what is the pre-period and what is the post-period? Come on, guys, can you please tell me? What is the pre-period? So the pre-acquisition period is from 1st October 20x4, from 1st October 20x4 to 31st December 20x4. That is 3 months. That is 3 months. 3 months. Now, what is the post period? So, if you ask about post period, it is 1st January 20x5 to 30th September 20x5. That is 9 months. That is 9 months. So this is the pre and the post requirement. This is the pre and the post period in the for the current year. Now let us read the question further. The share capital of the CureCell company, okay, Inventa company has acquired 80% of the CureCell. So Innoventa is the parent and CureCell is the subsidiary. Okay, fine. The share capital of CureCell is 7 million shares. Out of the 7 million, we have acquired 80%. Out of the 7 million, we have acquired 80%. So how much we have acquired? 5.6 million out of 7. 5.6 million out of 7 is what we have acquired. Okay. Now, Innoventa settled the consideration. Settled the consideration means what? Purchase consideration. Settled the consideration means what? Purchase consideration. Now, by issue of two new shares for in exchange for every 5 shares it acquired. In exchange for every 5 shares it acquired. Now, what is the purchase consideration? Can you please tell me, guys? Come on here. Let us calculate. Let us calculate the purchase consideration. Now, so it is a fair value of share exchange. Sorry. Fair value of share exchange. Now, guys, what we have to do here is we have to show the working for each and every calculation that we do. Now, how to show the working? So just press equals to here. Now, 7 million. Just focus on one thing. What is the data? What is the question's format of data? Question is writing everything in the absolute numbers. Question is writing everything in the absolute numbers. So we will write everything in absolute numbers. If the question would have written everything in millions, we would have solved the question everything in millions. If the question would have given data in thousands, we would have solved the question in thousands. Okay, but since the question is giving the data in absolute numbers, we will also solve in absolute numbers. Okay, now chalo, proceeding forward. Now, what is the total number of shares? 7 million. How much we have acquired? 80%. Now, this is what we have acquired. Multiply. What is we are offering? 2 for every 5. So multiply by 2 by 5. So these are the number of shares issued by Innoventa to the shareholders of CureCell. Now we have to multiply with the fair value per share of Innoventa. Now what is the fair value per share of Innoventa? Can you please tell me, guys? What is the fair value per share of Innoventa? It is fair value per share of Inventa is 6.5. So let's multiply this with 6.5. Multiply this with 6.5. Multiply 6.5. Okay, so this is the fair value of share exchange. Now let us read the question further. So we have already accounted for share exchange. Further, cash consideration was payable on 31st December 20x6. Now, when we have acquired on 1st January 20x6, we acquired on 1st January 20x5. We will be paying the consideration on 31st December 20x6. How many years? X5 full, X6 full. So after 2 years, we will be paying the purchase consideration. So it's a deferred consideration. So we have to write present value of deferred consideration. So what is the amount of deferred consideration at $3 per share acquired? So now tell me, what is the number of shares acquired? What is the number of shares acquired? Total number of shares was 7 million. We have acquired 80%. For each share acquired, we are paying $3. So this is what we will pay at the end of second year. But at the end of second year. So what is the value now? Okay, so we have to compute the present value. Now we can see here in the question gives us the present value factor. The question gives us the present value factor. So what is the discount rate which we will use? 10%. Inventa's cost of capital is 10%. So we'll use 10%. 10% for 2 years. 10% discount factor for 2 years is 0.826. 0.826, 0.826, 2 years, 2 years, 10% is 0.826. Okay, so now multiply with 0.826. Multiply with 0.826. This is the value of investments. Okay, assuming there is nothing else. Assuming there is nothing else. Now, on the date of acquisition, the fair value of Innoventa and Curcell is this much. Okay, fine. Then the statement of profit or loss is given. Statement of profit or loss is given. So now I will focus on my requirement number A. I will focus on my requirement number A, that is calculation of goodwill. Calculation of goodwill. Goodwill. Okay. So for that, I need investments. I need value of NCI on date of acquisition. For this, I have to check NCI is at fair value method or proportionate share method. Okay. And also I will need what is the fair value of identifiable net assets on date of acquisition. So out of this, as of now, I know only one data, that is a value of investments. I know only this much as of now. We have to find the value of NCI. We have to find the value of net assets on date of acquisition. Okay. So let's proceed further in the question. We have to make working note. We have to make working note number one. We have to make working note number one, that is statement of net assets. Statement of net assets. Now, so we have to write the date of acquisition, post reporting date. Right? Sorry. Let's just a minute. Let me reduce it. Cool. Now, what is date of acquisition? It is 1st January 2005. Reporting date is 30th September 2005. What is share capital? What is retained earnings? Okay, now let us proceed further. Share capital was given as 7 million. Okay, now share capital will remain the same on the reporting date as well, because there is no further issue of shares. Okay, now coming to retained earnings. Now, if I see the question, I will read from the adjustment number one. At January 20x5, that is on the date of acquisition, fair value of the net assets were equal to the carrying amount with the exception of the following. Okay, that is, an item of plant had a fair value of 4 million in excess of the carrying amount. Means we have to recognize a fair value adjustment. We have to recognize a fair value adjustment of 4 million on plant. 4 million. 4 million. Okay, cool. Now, in excess of the carrying amount, on the date, its remaining useful life is 4 years. So what is the subsequent depreciation on this? Divided by 4 years. But will we charge the depreciation for the entire year? No, only for the post acquisition part of the current year. What is the post acquisition part for the current year? 9 months. See, we computed here 9 months, 9 months, 9 months, right? So multiplied by 9 by 12. Is it clear, everyone? So this will reduce the profitability. Okay. Okay. Chalo, cool. Now, a contingent liability arising from present obligation that was not probable and has not been recognized. This had a fair value of 125,000. Okay. So fair value of contingent liability. How much? 125,000. Cool. Since contingent liability will be recognized as a provision for contingent liability, which is a liability which will reduce the net assets. That's why I have written a negative figure here. Okay, cool. This is also sorted. Now, point number two. Innoventa chooses, point number two, if you see, it says Innoventa chooses NCI to be measured at fair value using the Curcell share price to determine the fair value. Okay, so we have got the second data also here, NCI. So it is at fair value. It is at fair value method. Now, what is the implication of fair value method? NCI at fair value method. If there is a goodwill impairment, it will be allocated to parent and NCI both in the ratio of their share holding. Is that clear, everyone? Now, what is the fair value of NCI? So total number of shares was 7 million. NCI has 20%. Now, what is the fair value per share of subsidiary? That is Curcell 4 multiplied by 4. Okay, so this is the NCI value on date of acquisition. Now, going forward, we have used adjustment number 1 and adjustment number 2 properly. Adjustment number 3. On 1st October 2004, that is date of that is at the beginning of the year. At the beginning of the year, the retained earning was 12 million. So I can say here, retained earnings was 12 million. Okay, it is more 12 million on 1st October 2004. On 1st October, on 1st October 2004. Okay, now from 1st October 2004 till 30th September 2004, X5, we have earned profit. We have earned profit. Now, what is the profit that we have earned? Just check yourself. Profit is 4065,000. So now this 4065,000 will be allocated to date of acquisition and post in the ratio of the holding period. And what is the holding period? Date of pre is 3, post is 9. So I will write here is equals to 4065,000 multiplied by 3 by 12 and equals to multiplied by 9 by 12. Tell me, guys, is that clear, everyone? Is this clear, everyone? Okay, now, so we have dealt with adjustment number 1, yes. Adjustment number 2, yes. Adjustment number 3, yes. Moving on to adjustment number 4. In the post-acquisition period, during the post-acquisition period, Curcell sold, subsidiary sold to parent, subsidiary sold to parent. Tell me, what is the treatment of subsidiary selling the goods to parent? What is the treatment of subsidiary selling the goods to parent? Okay, we definitely will reduce the profit, unrealized profit from the inventory, closing inventory. Okay, now we will also reduce the profit. We will also reduce the profit of subsidiary company. Okay, so in this statement of net assets, what will be the treatment? What will be the treatment? Okay, so I'll write here less unrealized profit. Okay, unrealized profit S to P. If we drop in parent to subsidiary, it would have adjusted in console RE. Now, what is the amount? Now, what is the amount? Okay, it has sold 250,000 per month. Okay, margin is 25%. Closing inventory has 300,000 of good bought from Curcell company. Okay, so unrealized profit is equals to minus 300,000 into 0.25. Now, a student might ask me that, sir, please tell me, do I need to write the calculation here also separately and then equals to here also separately? No. Even if you're writing the answer like this, it is fine. It is understood. It is assumed that you have shown the workings, because when your paper will go to an examiner, it will go in this open format. Okay, so they will see what is the formula that you have applied. But let's suppose you are value punching. Let's suppose this value came as 75,000 and you just write 75,000. Then in that case, examiner will not be able to understand what is the calculation that you have used behind 75,000. But if you use this, examiner will be able to see the calculation that you have shown here. Am I clear? Am I clear, everyone? Come on, guys, tell me, please. Wonderful. Now, moving forward. On 1st October 2004, Innoventa issued 3 million. So this is a treatment to be done in the books of Innoventa, not in the books of Curcell. So let's ignore it off. Goodwill impairment, not in this statement of net assets. So let's ignore it off. Fine. So I think we have fairly completed this point. So let us close it off. Net assets. Net assets. Let us do the total of it. Is equals to sum. Okay. Now 238,238,91,250. So now let us come here in statement of net assets minus. This is the net assets. So what is your goodwill? What is your goodwill? on date of acquisition. So your goodwill on date of acquisition is 101,45550. Okay. Now less goodwill impairment. So the question says that the goodwill is impaired by 25%. Goodwill is impaired by 25%. Okay. So let's impair goodwill by 25% is equal to this multiplied by 0.25. Okay. So this is your goodwill impairment. Okay. So now what is the value of goodwill on reporting date? It is this much. This is the value of goodwill on reporting date. Tell me guys, is that clear everyone? Is that clear everyone? Okay. Now, cool. So we have very well answered the first part of the question, first requirement, that is calculation of goodwill. That is calculation of goodwill. Now moving on to the next requirement, that is requirement number B, to prepare consolidated P and L. Okay. Now in this requirement, consolidated P and L, it is for the year, is for the year ended 30th September 20x5. Okay, now let us prepare the console panel. But now understand few things very apparently. Now in Aventa, we will take the entire P&L as it is, no challenge at all. Cure Cell, we will take only for 9 months. Is that clear, everyone? Why? Because the subsidiary was acquired during the year on 1st January. This P&L of Curcell is from 1st October X4 till 30th September 2004. But we have acquired subsidiary midway. So we'll take the post-acquisition part only. So before making any adjustments for any information given, I will just take up Innoventa plus 9 months of cure cell. Okay, so let me take that. Plus 24750. So far in this P&L, I have not done any adjustment. I have done simply P plus S into 9 by 12. This is the only thing that I have done, nothing else. Now what we'll do is we'll start doing the adjustments one by one. Okay, now come here. On 1st January 2005. We'll read from the start till the end, and let us, you only tell me what all the adjustments are required to be done. On 1st January 2005, Innoventa company acquired 80% equity capital of Curcell. The share capital of Curcell consisted of 7 million shares of $1 each, settled the concession by issue of 2 new shares. Tell me, fair value of share exchange. Any impact on P&L? Any impact on P&L? No. Then cash consideration, oh, deferred consideration. Any impact on P&L? Yes, yes, yes. Tell me what impact? What impact? Unwinding impact. Deferred consideration. Okay. So now what about deferred consideration? It will add up here. That is plus uh, plus finance deferred consideration, uh, finance costs on deferred consideration. What is the amount, guys? Come on, please tell me. The amount will be, I'll write here, note 1. I'll ask right here, note 1. Okay, finance costs on deferred consideration will be equals to right, deferred consideration we have computed here, as this one multiplied by 0.1, that is 10%, multiplied by 9 by 12. It is 1040760 is the amount, right? So let's write here 1040760. This is the amount of finance cost on deferred consideration. Is that clear, everyone? Is that clear, everyone? Okay, now, anything else here? No. Fine. Chalo, come here. Adjustment number one. Plant fair value adjustment. Yes, excess depreciation on fair value adjustment will impact the profitability. Where will it impact? Where will it impact? So question clearly says here. Question clearly says it will be charged to cost of sales. Okay. So let us add depreciation. Add depreciation. What is the depreciation? Can you please tell me the amount? Depreciation is 750,000. Okay, cool. Now, contingent liability doesn't have any impact in the post period. Innoventa, NCI, no impact. Now, retained earnings, no impact in the P&L. Unrealized profit, unrealized profit. Okay, yes. So we have to add the unrealized profit here. So plus unrealized profit. What is the amount of unrealized profit? Can you please tell me what is the amount of unrealized profit? 75,000. So let us add 75,000 here. Now, one more thing, intra-group trading. Intra-group trading is of what amount? 250,000 every month. For how many months? 9 months. So what is the amount? 250,000 into 9 is 2.25 million, right? So we have to reduce it from the revenue and cost of sales both. Okay, so it is 225 contra intra-group trading. Okay. Now, fine. So adjustment number one done, two done, three done, four also done, five. Okay, five will do. Six we have done already. Six is just a discount factor, so nothing to be done here. Seven is a goodwill impairment which will be charged to admin expense. So good, what is the amount of goodwill impairment? Tell me. Goodwill impairment is 2536388. 2536388 it will be charged to admin expense. So I'll write here plus goodwill impairment 2536388. 2536388. Okay, so this adjustment number 7 also done. Adjustment number 7 also done. 4 is done. Then 6 is nothing to do. 5 is pending. So 5 and 6 is pending. So let us look into 5 and 6 and we will be done with that also. Okay. So now, what is adjustment number 5 saying? Let us read the question. On 1st October 2004, meaning thereby at the beginning of the year, okay, Innoventa issued 3 million 5% convertible loan notes. Interest is payable in arrears for 5-year period. The interest rate of equivalent non-convertible loan notes was 7%. Innoventa recorded the liability of the amount of proceeds received and recognized the interest expense of 5%. Is it correct? So it's a compound financial instrument which we have to break into equity and financial liability. What the question has done, they have recorded the entire amount received as liability. Is it correct? Is it correct? Come on, guys, tell me. Is it correct? Is it correct? No, it is not correct. No, it is not correct, right? We have to split the instrument into equity and financial liability. Now, what is the impact on the P&L? In P&L, we'll record the unwinding of the financial liability, that is finance cost. Finance cost. Okay, so we will remove the finance cost on the basis of this 5%, and we will add the finance cost on the financial liability using this 7%. Okay, so now let us do the calculation. Note number 2, compound financial instrument. Okay, what is the present value of principal and what is the present value of interest component? Okay, so principal is 3 million, right? If I'm not wrong, it is 3 million. It is 3 million, right? Now, so 3 million present value is equals to 3 million multiplied by we have to discount using 7%. So 7% for 5 years, 7% 5 years discount factor. 7 years, 7% 5 years discount factor is this much, 0.713. 0.713. Okay, so this is the present value of the principal. What about the present value of interest? So 3, contractual rate is 5%. Now we have to take 7%, 5 years, annuity factor 4.11. 4.1 multiplied by 4.1. It's equal to 615,000. 615,000. So if I add both, it becomes 2754. So this is your financial liability. So what is the finance costs? What is the finance cost on this one? It is for the entire year. Don't do a pro rata for 9 months here. Don't do a pro rata for 9 months here. Why? Don't do a pro rata for 9 months here, because it is for the parent, not for the cure cell. 192,780. So what is the finance costs already recognized in P&L? It is 303 million multiplied by 5% is this much. So what is the finance cost extra that we have to record? What is the finance cost extra that we have to record? It is 42780. So let us add the finance cost. Let us add the finance costs. Add the finance costs, okay, on compound financial instrument. What is the amount? 42780. Okay, now, so let us close the amount and finalize it off. Let us finalize the console P and L now. Let us finalize the console P and L now. Just a minute. So amount is this minus goes to this plus okay. So the gross profit is revenue minus cost of sales. Okay. Now I believe this adding part you can do on yourself also. That's not a big deal, but still take it. I can help you in the same. Plus 2536 8. Okay. Now, why I'm doing it, because I can show that NCI part. That's why I am doing it. Otherwise, I would not have done. This is the final profit. Now, if you can, if you remember, we have to do one more thing here. Do you remember that? Allocation, allocation, allocation of profit to allocation of profit to owners of Innoventa and NCI. Are you aware of this one? Come on, guys, tell me. Are you aware of this one? We have to do this allocation part also, right? So now, come on, let us do this allocation. Okay, now tell me, what is the post acquisition profits of Cure Cell? What is the post acquisition profit of Cure Cell? It is 4065,000 multiplied by 9 by 12. Okay, now what are the adjustments? Tell me, which impacts the profitability of Innoventa. Now, this intra-group, no, it doesn't, because we eliminate revenue and cost of sales both, so it doesn't impact the profitability. Okay, now let us go further into depreciation. Will it impact the profitability? Yes. Okay, so I can write here less depreciation on fair value adjustment. Okay, what is the amount? It is 750,000. 750,000 minus. Let's put a negative sign. Okay, now less unrealized profit. What is the amount of unrealized profit? 75,000. Okay, so minus 75,000. Okay, done. What's next? This two done. Now, goodwill impairment, will it impact the profitability of subsidiary? Yes, since NCI is at fair value method, we will be adjusting goodwill impairment as well. Goodwill impairment. 2536,388. 25 minus 2536,388. Okay, cool, done. Now, finance cost on deferred consideration will it impact the profitability of subsidiary? Now, finance cost on compound financial instrument will it impact the profitability of subsidiary? No, 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 no. So this is what it is. So can you please tell me what is the amount? This much. Oh, it's a loss figure. It's a loss figure I can see. It's a loss figure I can see. It's a loss figure. It's a loss figure of 312. So what is the share of NCI? What is the share of NCI? 20%, right? 20% into 0.2 is negative 62528. Negative 62528. So I can write here the NCI part negative 62528. Okay. Now, what will be the profit to the attributable to the owners of Innoventa is equal to this minus. So this is what is the allocation. Tell me guys, is it clear everyone? Is it clear everyone? Now moving on to the third requirement of the question. The third requirement, if you see here, read the requirement, read the requirement. Let's read the requirement first of all. Let's read the requirement. IFRS 3 business combination allows two methods for the measurement of non-controlling interest at acquisition. Okay, the fair value method and the proportionate share method. Yes, we do agree. Explain how the initial calculation and the accounting treatment of the subsequent impairment of goodwill arising on the acquisition of Curcell would have differed had the non-controlling interest been measured at proportionate share method of the net assets. So now tell me how will it impact? So on the initial calculation, we would have taken NCI at the proportionate share of net assets. Okay, that is here, if I show here, if I show NCI balance will not be this much, rather NCI balance would have been this multiplied by 20 percentage. Okay, and you can calculate the value of initial goodwill. Now, what is the treatment of goodwill impairment? If NCI would have been a proportionate share method, goodwill impairment will not be applicable to NCI, meaning thereby this goodwill impairment part we would have not written here. This goodwill impairment part we would have not adjusted it here. Okay, because goodwill impairment goes to parent and NCI if NCI is at fair value method. But if NCI is at proportionate share method, goodwill impairment goes only to parent. Is that clear, everyone? Is that clear, everyone? I believe we have discussed this question of Innoventa very clearly in depth. Okay? Chalo. Now we'll discuss the next question of FR pre-mock March 2026. Okay, and this is a question of interpretation. But before I discuss this question, I want to highlight few important points. Now tell me, when you read the examiner report and the technical articles of FR, you will find the examining team highlighting multiple times, time and again they are highlighting three issues particularly. They are highlighting three issues particularly. Can you please help me with those three issues, guys? Come on, tell me. Can you first of all please help me with those three issues, all of you? Now, point number one. Point number one is, and the examining team is of the point that if students can work on these three issues, their interpretation answers will improve like anything. Point number one. Guys, we know whenever a question is asked on interpretation, it is divided into 2 to 3 segments. One is the calculation of ratios. Second is your analysis or interpretation, which we say. And third, sometimes they ask you to give some limitations, right? Or some future aspect, something of that sort. So now this part generally comes for around 6 marks, 5 to 6 marks, I can say. Generally, around 5 to 6 marks, definitely it is asked for around 5 to 6 marks. On a higher note, it can be for more marks also. Okay, but generally in the range of 5 to 6 marks. Generally, it is asked in the range of, you can say, 10 to 14 marks. Okay. Now, and this one is generally asked in the range of 3 to 4 marks. Do you agree with me in this one? Come on, guys, please tell me. Do you agree with me on this one? Okay. Now, the examining team is telling, the examining team is telling for this part, okay, always, always, so workings. Now, in every batch, when I say workings, what students understand is formula. No, I am not talking about formula. I am not talking about formula. I am not talking about formula. Formula, even if you don't write, it's totally fine. You have to show the workings. Let's suppose the question is ROCE. Then you have to show what is the operating profit. So you have to show like this. You have to show like this. Operating profit is 1 to 300 divided by how is capital employed arrived at. So you have to write x figure for equity plus y figure of, you can say, non-current liability plus y figure of current maturities of the long-term debts. You have to write this one, and then you write this percentage is your ROCE. So this is what workings you have to show. This is the first point which the examining team is highlighting. Tell me, guys, will you provide this working? Everyone, come on, please tell me. Will you provide these workings? Come on, tell me, guys, please. Now, the next part in the analysis, the examining team is telling in the analysis, students are just writing ratio has increased or decreased, and they are not writing any reasons for the increase or decrease. Point number one, they are not writing the reasons. No reasons. No reasons. Is it correct? No, it is wrong. Now, there are another set of students, they are writing reasons, but they are writing bookish reasons. Bookish reasons, okay? Gross profit has increased. Why? Because revenue has increased. Revenue is increased, that's why gross profit is increased. No, this is not you are required to write. Okay, so bookish reasons, no. Is it acceptable? No, it is not acceptable. Again, it is not acceptable. Again, then what are you required to do? What are you required to do? Okay, you are required to break the elements. You are required to break the elements of ratio. You are required to break the elements of ratio and then see which element increased or decreased and why. And now this why should be linked to the scenario. Now you will ask me, sir, Can you please give an example? Yes, Bacha, I will give an example. Please understand. Please understand. Let's suppose you are required to comment on return on capital employed. Okay. Now, return on capital employed has decreased significantly during the current year. So you have to find out what is the meaning of ROCE. Then you will find ROCE is operating profit divided by equity plus non-current liabilities plus current maturities of non-current liabilities. Okay. Now, then compare what was the operating profit in the previous year, what is the operating profit in the current year. Is it increasing, decreasing? Comment on that. What is the non-current liability of the previous year, current year? Is it increasing, decreasing? Comment on that. Equity. What was the equity of the previous year? What is the equity of current year? Now, might be the current year equity has increased significantly. Might be the current year equity has increased significantly. Why? Because of the revaluation surplus. Now, denominator increased, ratio went down. Denominator increased, ratio went down. Ratio went down. Sir, you will say, sir, operating profit of the previous year and current year both are at the par. Operating profit of the previous year and the current year both are at the par, but still return on capital employed has decreased. Why? Because your equity has increased because of revaluation surplus. So this is how you are required to comment. Break the elements and evaluate which element increased or decreased and why. And the why should be linked to the scenario. Now, the again the next point is think about the future. Will this element exist in the future or not? One-off costs, revaluation surplus. So now accordingly do what if analysis. So if in the future revaluation surplus will not exist, then what will be the return on capital employed? Okay. If in the future this significant gain or loss will not exist, then what will be my future ratios? Okay. So think from that perspective and then comment on the ratios. So these are the few points which examining team is asking you to keep in mind. Okay. This is point number one. This is point number two, and this is point number three. These are the major 3 points which the examining team is asking you to keep in mind. Tell me, is that clear, everyone? Come on, guys, please tell me, is it clear, everyone? Now, moving on to this question of FR pre-mock March 2026. Okay. Now, let's read. First of all, understand the structure of the question, understand the requirement, and then we will proceed further into the solving the question. Okay. Now, so Vogue Stop, a football retailer. Just now, understand when you read the question, identify which type of question. I have identified 5 types of question, right? Company versus company, company versus sector, company for the previous year, company for the current year, acquisition of a subsidiary, disposal of a subsidiary. There are 5 types. Identify which type of question it is. वो company, a footwear retailer, changed its sales strategy at the start of the financial year ended 31st December 2005. As a result, the company closed majority of its retail stores and transitioned to e-commerce business model. Although its main focus is on online sales, it still has 4 outlets as a flagship store. Main competitor City Fleet has not embraced e-commerce. Okay, so you are comparing Vogue Step with City Fleet. Ideally, I can see it's company versus company, company versus company for the same year, company versus company for the same year. But let's proceed further. Vogue Stops P&L is given for the year ended 31st December 2005. SOFP of the Vogue step is given for 31st December 2005. Then City Fleet, the competitors, ratio is given for 31st December 2005. So now it becomes very apparent. Now it becomes very apparent. It's company versus company. We have to compare 2 companies. We have to compare 2 companies. Okay. And now then we have to comment. Now, what are the requirements of the question? Just see. Calculate using the pre-formatted table the equivalent ratios for the Vogue step. Okay. The ratio is for 5 marks. Analyze the financial performance, liquidity, and the working capital efficiency for 11 marks, and four limitations for 4 marks. Okay, so now tell me, in these I can believe this 5 marks plus 4 marks, these 9 marks are easy. They are very easy peasy. Now, out of this 11 marks, if you write logically, you can very well easily score around 9 marks. So 9 plus 9, 18 you can easily score out of 20. 18 you can very easily score out of 20. Okay. So now let us read the question, try to understand the question and write our commentary. Okay. Chalo. Vogue Step, a footwear retailer, changed its sales strategy. Changed its sales strategy. At the start of the financial year. Okay. As a result, the company closed majority of its retail stores during the year and transitioned to an e-commerce business model. Although its main focus is on online sales, Vogue Step retained four outlets in the key cities to be operated as a flagship stores. Do you know what is a flagship store? Ideally not required, but do you know what is a flagship store? Come on, guys, tell me. Do you know what is a flagship store? In this era of e-commerce, it definitely has given a normal person a very ease that you can order at the comfort of home. But let's suppose in this era there is also a lot of fraud happening, right? Tell me, in the online you will see something, when the product comes to you, you will get something else, right? So how do you trust that store? How do you trust that brand? How do you trust that brand? So what happens, you will see top online brands, they open up a flagship store. Now what is flagship store? Customers can go visit that flagship store, they can see the product, what exactly they will get, experience the product, okay, and then they can order the product from online, or if they want to purchase from the flagship store, they can purchase from the flagship store also. Okay, so now this flagship store concept provides the you can say the e-commerce business a trust, plus the reach of the larger market both. Okay, the trust of the customer, that the customer can go and visit the flagship store and check the product. Okay, and it also, with since the business model is online, they can reach a larger number of customers. Okay, you understood the meaning of flagship stores now. Now, Vogue Step's main competitor, that is City Fleet, has not embraced e-commerce. So basically, the company Vogue Step will get the first mover advantage because the competitor has not yet entered the e-commerce market. It continues to operate in a large network of physical stores. So now, can I tell me, will I be correct to say the operational costs of City Fleet will be higher? Come on, guys, tell me. The operational costs of City Fleet will be higher. Come on, guys, tell me yes, no, something. Right? Why? Because they have large network of physical stores. Physical store comes with rental costs, maintenance costs. Extracts of the financial statement of Vogue Step is given below. Okay, ठीक है. Revenue is given, cost of sales is given, gross profit is given, operating expense, everything is given. Data is given about P&L. Data is given about SOFP also. Okay, fine. Now just run through SOFP, PPE, intangibles, investment property. Intangible is a website. Okay. Now current assets are inventories. Inventory is a very small figure. Prepayments, trade is for zero. Point to be noted, my lord. Point to be noted, my lord. What we say? Point to be noted, my lord. Zero trade receivables. Why? Why? Tell me why. Online model, no credit sales. Online model, ideally no credit sales. Cash and cash equivalents. Okay, loan notes, current liabilities, trade payables, current tax liability. Okay, now this is the ratio that is already given for the city fit. Now there is some other additional information we can see here. Vogue Step frequently uses promotional discounts to incentivize customers, okay, to make purchases on their e-commerce platform. Vogue Step customers make full payment when they order goods online or buy them in store. Credit is not provided here. It is linked to here. That's why there are no trade payables. That's why there are no trade payables. Okay, now although although it is Vogue Step's main competitor in the retail market, City Fleet also generates 30% of its revenue from wholesale credit sales to other customer retailers. Now, what does it mean? What does it mean? That this Vogue Step sells only B2C, but City Fleet sells 70% B2C and 30% B2B. Is that clear, everyone? Why? Because it is given this one. Other retailers. Other retailers. Now, during 20x5, Vogue Step sold majority of its retail own retail store, recognizing a significant gain or loss on the disposals. So the profitability might be higher in the current year, but it is a one-off. But it is a one-off event. It is a one-off event. Okay. If we see from a future perspective, will the company get this gain or loss every year? Now, understand. I'm telling the point again. The company initially earlier had a lot of physical stores, come on guys, tell me yes or no. In the current year they changed the model from physical to online. So what they did is, except for these four, they sold all the physical stores. Now when they sold all the physical stores, there will be gain or loss. There will be some gain or loss. Come on, guys, tell me. There will be some gain or loss, right? That's why saying Vogue Step sold majority of its own retail stores, recognizing a significant gain on the disposals. It retained its four flagship stores and a number of other outlets. Okay, so now apart from the four flagship stores, it retained few other outlets also, which they kept for rental yield. Okay, let's suppose they had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. So now this is a flagship store, flagship store, flagship store, flagship store. Okay, so now they sold this one, they sold this one, 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 right? So now they retained this one, 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 retained this one. Now whatever they have sold, whatever they have sold, whatever they have sold, okay, now there will be gain on disposal. Whatever they have retained, they were given on rental to someone else, and there was a rental yield. Now given on rental to someone else will attract what? Two things: rental income and fair value gain loss. Rental income and fair value gain loss. That's why if you see in the P&L, there is a fair value gain on investment properties and rental income, right? This is also coming up here. Is it clear, everyone? Is it clear, everyone? Come on, guys, please tell me. Now, few more points. Vogue Step has made arrangements for with its suppliers to dispatch most of the goods directly to customers, meaning thereby, to Vogue Step, what he's doing is, he just becomes a marketplace. Customer comes to the website of Vogue Step, places the order, Vogue step will intimate the same to the supplier. Now the supplier will transfer the goods directly from its place to the customer, to the customer. So Vogue step has reduced its costs of inventory management as well, has reduced the cost of inventory management as well. Okay, so you will see the operation or the operating profit of Vogue step will be quite higher as compared to that of City Fleet, because there is no inventory management costs. Now, the customers bear 50% delivery costs. Okay, now, Vogue Step's operating expense include costs of 12 million related to new e-commerce platform, including expenditure on digital marketing and brand building. Now, this will increase the operational costs. This will increase the operational costs. Okay. Cash and cash equivalent includes 25 million in short-term deposits raised from the disposal of the retail stores that it intends to use for expansion of the new market planned for the next year. Throughout the year, Workstep employed an average of 120 full-time members of the staff. So this is the comment, this is the information given in the question. So now we have to compute the ratios. We have to compute the ratios and then we have to analyze and we have to give limitations. Now, come on, guys, tell me, were you able to compute the ratios? Were you able to compute the ratios? Come on, guys, tell me, please. Okay, so now I am not going into the ratio computation part. So I have just taken up the answers screenshot as it is for the ratio computation. Ratio computation, if I will show you, it's very easy. Gross profit margin is gross profit by revenue. Operating profit margin is operating profit by revenue. Assets turnover is revenue by capital employed. Capital employed, what is capital employed? If you see, capital employed is equity plus non-current assets. Okay, now non-current liabilities, equity plus non-current liabilities. Then revenue per employee is revenue by the total number of employees. In the current ratio is current assets by current liabilities. Inventory holding period, inventory by cost of sales into 365. Same receivables collection period, no receivables, no credit sales, so zero. Payables payment period, trade payables by the cost of sales. Working capital cycle is you can say inventory holding period plus receivables collection period minus payables payment period. So you can see a negative working capital cycle, which I can say is something very rare we see. Something very rare we see. We will comment on that also. So ratio computation, I believe, is quite very easy, which you can handle it around. Say that's not a challenge, I believe. Come on, guys, please tell me. Come on, guys, please tell me. Is it clear to everyone? Now, so we have to comment on three things: financial performance, financial performance, short-term liquidity, and working capital efficiency. Okay, before I start, come on, guys, tell me, the revision marathon which I took, all of you watched that? All of you watched that? Was it, did it help? Did it help the revision marathon? Sure, good, good, good. Now, let us comment. If you have not watched it, you should go and watch my revision marathon. It is there in the live section of my YouTube channel. Okay. So financial performance. Financial performance means what? Profitability. It means what? Profitability. Now in the profitability, we have the first ratio as gross profit margin. The gross profit margin of the city fit our competitor is more than the work step. Tell me why. The gross profit margin, GP margin, you can say is lower. GP margin is lower as compared to the competitor. Why? Tell me, guys, why? One reason I can see apparently, one reason I can see apparently is promotional discounts. Promotional discounts offered by Workstep. Second reason, if I see this city fleet is operating from premium stores. Now you will see the premium stores charge a premium price. Tell me yes or no? The price which you have to pay for a product if you purchase it online will be quite comparatively less as compared to the price which you pay if you purchase from the store. Agree with me? Right? A premium pricing of city fleet or city feet, city feet, city feet. Right? Now, that's why you can say the gross profit of city feet is higher, lesser sales due to no credit option available. Ideally, you can write. See, whatever you want, you can write. It just has to be justifiable. Okay, but please understand. Okay, they are in the business of what? Just see the business, understand the business line, and apply some commercial acumen. Footwear retailer, shoes. Have you ever purchased shoes on credit? Apply some commercial acumen, right? Your justification was not wrong, but when we apply commercial acumen, when we think logically, it doesn't hold good now. Okay? No, it's not wrong. It's not wrong. See, I told always, Bhavi, I have always told you have to write 11 points only. For 11 marks, you need to write only 11 points. If you just read the question properly, you will find around 15 to 16 points. Out of that, you need to write only 11 points. Even if you don't write this point, it's completely fine. You might write some other point. Okay, so you need to think from 11-point perspective. That's all. Okay, now, second point. What is the ratio? Second ratio, operating profit margin. Operating profit margin. Is it, what is the comparison? So operating profit margin is higher. It is higher. It is higher. Why? Why? Point number one. Point number one is lower operational costs due to online model of business. Online business due to online business model business not requiring stores, not requiring physical stores. So the cost gets reduced there. Point number one. Point number two, lower employee costs. Lower employee costs. Point number three, lower inventory management costs. Point number four, lower rent. That's what I've written. Yeah, you can write rent. You can write in your words. If you want to write lower rent expense, yes, you can do that. Yes, you can do that. But just only concern here is the question has not mentioned whether it was rental or purchased. But and the question is also giving you a hint that we have sold means it was already purchased. It was already purchased. Okay, so rental or depreciation, lower rental or lower depreciation. Okay, So that's why I have written here, neither I'm writing rental nor I'm writing depreciation. I'm just writing lower operational costs. Okay, it covers rental or depreciation. If it was leased, it will reduce my rental cost. If it was purchased, it will reduce my depreciation costs. Okay, now lower inventory management costs, then significant gain or loss on disposal of retail outlets. See, you have written 4 points, but at that moment, whatever you can think of, you have to write that. See, you have to write only 11 points, and you have written only 6 points here itself. I don't know. In this question, if you think logically, you can write as good as 17 or 18 points, but you are required to write only 11 points in the exam. 11 marks, 11 points. Can we say no brand cost like franchising? Subho Sarkar, was it mentioned that previously we had to pay brand costs? Why should we go outside the arena of the question? Was it mentioned that City Fleet paid brand costs? No. Was it mentioned that previous year when we were doing it, we had brand cost of franchising? No. Not or we are ourselves a brand, right? This Vogue step is in himself a brand. Okay. Now, so operating profit margin discussed. Then comes the next one is asset turnover. Asset turnover ratio. Since we are not asset based industry, we are working on online model, so assets reduces significantly, revenue remains same, therefore assets turnover ratio will ideally increase. But let me see what is happening. It is increasing. See, it is increasing. It is increasing. It is increasing. So assets turnover ratio is increasing because of this one. Assets turnover ratio is increasing. Tell me yes or no. Clear, everyone? Clear, everyone? Now, a return on capital employed. Tell me what is it happening? Increasing or decreasing? Return on capital employed is increasing significantly. 12 to 21.48 increasing. Tell me the reasons. Tell me the reasons. Again, one is a significant disposal gain, gain on significant disposal of the assets. What else? Tell me, guys. Come on. What else? You can say carry forward impact of operating profit margin. You can say carry forward impact of operating profit margin. Now, further, you can also go on state. There were few properties given on rental. So rental yield is also coming. See here, rental yield is also coming now. See, rental income. Fair value gain is also coming. So we can say that also. Fair value gain. Tell me, is City Fleet getting this rental yield? Is City Fleet getting this rental yield? No, because City Fleet is using the property. City Fleet is using the property. Now, this City Fleet is using the property, but Vogue Step is not using the property. They have given on rental to others. Fair value gain loss. Fair value gain loss, right? I believe you are understanding these points. Come on, guys, please tell me. Clear? So ROCE is done. What else? So we have commented on this, this, Revenue per employee. Okay, fine. Okay, that's not a profitability ratio. We can find it's fine. So we have already completed financial performance. Now we are moving on to the next point, that is short-term liquidity. Tell me, from a short-term liquidity, we will comment on what? Tell me, from a short-term liquidity and working capital efficiency. They are same thing, right? So we have to comment on, we have to comment on current ratio. We have to comment on these ratios now. These ones. Current ratio. Okay. Now tell me. Come on, guys. Why do you think current ratio? Okay, let me just cut it. Copy. Paste. Current ratio increased. Tell me, guys, why do you think current ratio increased? Why do you think current ratio increased? Come on, guys, tell me. I'm myself reading the question. I am myself reading the question. Come on, guys, tell me. Why do you think current ratio increased? If you can see the question here, it says one point. Cash and cash equivalents 12 million in the short-term deposits, right? So which were received in the current year, short-term deposits, because it includes a cash balance of 25 million. Okay, and this or which came from short-term deposits on sale of the properties, on sale of the properties, on sale of the properties. Okay, now which is not existing in the future. We will not sell the properties in every year. We will not be selling the properties every year, right? It's a one-off event. It's a one-off event. Okay. Now, inventory holding period. Inventory holding period. So now see here, City Fit is having an inventory holding period of 120 days, and this company of only 16 days. Why? Because they directly supply from the suppliers to the customer. They are managing a very less inventory. Point number one, directly from supplier. Point number two, very less inventory. Very less inventory managed by Vogue Step. Very less inventory managed by Vogue Step, right? See this point. See this point. Vogue Step has arrangements with the suppliers to dispatch most of the goods directly to customers. Means I am not purchasing it. I am asking suppliers to directly transfer to customer, and also maintains a central warehouse to keep a minimum level of stock. Less inventory, less inventory, less inventory. Number of days inventory holding period is less. Inventory holding period is less in that case. Okay, now the receivables collection period is zero. Why? Because no credit period, no credit allowed, no credit allowed, no credit allowed by Vogue Step. Payables payment period is quite very less, is very less. I can say a better bargaining power. Better bargaining power. Better bargaining power. Now here, if you see, working capital cycle is 90 days for City Feet and only negative 25 days. Means, understand, the money is recovered before it goes. See, understand, our 16 days are held. 16 days are held, okay, to recover from in selling the inventory. Okay, we purchase the inventory. Let's suppose, understand what is the meaning of, how do you read this negative 20, negative 25 days? How do you read? Let's suppose I purchased the goods from inventory on 1st of January. I purchased the goods from inventory, goods from the supplier on 1st of January. Okay, I am able to sell the goods on 16th of January. And since no credit sales allowed, so I will recover the cash here. I will recover the cash here. But you know what? When will I pay? When will I pay? I will pay to the supplier after 41 days. So from here, 41 days. That is, that is you can say around 10th of Feb, I will have to pay. Means the cash that we collect, we can use it here. So means the suppliers funds, we are able to use the suppliers fund. We are able to use the suppliers fund for this period. We are able to use the suppliers fund. That's the best strategy, I can say. That's a good strategy. That's a good strategy, right? Collect early but pay delayed. Pay delayed. Collect early but pay delayed. Yes, but if the delay is too longer as compared to the market terms, that's wrong. That's wrong. But if we see, if compared to the market terms, we are paying in a lesser number of days. In the market, City Feet is paying within 60 days. We are paying within 41 days only. We are paying within 41 days only. So it doesn't impact our reputation. Okay, yes, Aditya, you can very well write that. You can very well write that since we are paying early, it creates a good reputation in the market. It creates a good reputation that we are paying early and still using the funds, still using the funds for additional number of days, right? So this is what you have to comment. So I believe if you go on writing, you can write 17 or 18 points. But will we go on writing 17, 18 points? No, we have to restrict ourselves to only 11 points. Only 11 good points, right? That's all. That's all. Nothing else. Nothing more, nothing less. That's all. Okay, sir, can we write the answers in the pointers form? Yes, you can write that. Not a challenge at all. Not a challenge at all. You can write your answer in the pointers form. Not a challenge at all. Okay. Now, additionally, you have to give your conclusion as well. In the conclusion, you can write the company has shifted from physical store to online model, and the company's profitability has increased. Company is highly profitable. The company is profitable as compared to the one we see for the physical stores. Okay. Now, this is the conclusion which you can give. Now, if you come to the third requirement of the question, the third requirement, which was four limitations for the use of the ratio analysis for comparing the financial performance and financial position of the two companies. I have already discussed. You have to explain. I'm writing just the list. I'm just writing the list. You have to explain. Okay, explain in one sentence, not much, one sentence. That's all. It can be different accounting policies, different accounting policies. You might also write different reporting dates. But we see in this question, the reporting date of City Feet is also 31st December, and the reporting date of Vogue Step is also 31st December. So we can't write different reporting dates here. Different ratios. Now understand, for a company under physical store, the ratio which is important can be something different from the ratios which highlight the performance of an online model. The two models are different from each other. Okay, so let's suppose we operate in a business online teaching. We operate in online teaching. Okay, the profitability ratios for us can be different from an educator who teaches in the face-to-face business model. Okay, so it is quite significantly different. It is significantly different. Significantly different. Okay, now the next part. The next part. The ratios just shows the average. The ratio just shows the average. Okay, company might have a product which is significantly at a loss making, and the company might have a product significantly profit making, but the ratio will just show on an average this is the profit margin. Okay, they just show the average, they don't show the extremities. Okay, now what else, come on guys, tell me. Ratios talk from a historical perspective. Ratios talk from a historical perspective. Ratios are not predictive of the future. Ratios are not predictive of the future. They just talk what has happened in the past. Okay, so these are the few limitations which you can write in the exam. Okay, I have just given you the list. You can explain it in a more elaborate manner. If from one sentence for each list, one sentence for each pointers which you can give, and it will be done. I believe we have discussed this question as well. Is it clear, everyone? Come on, guys, please tell me.